Uh, Good evening, everyone. Hello and assalamu alaikum. Welcome to the fourth day of this exam session, exam focus webinar for the December 2019 exam session for the paper Taxation Pakistan variant. I welcome you all to this webinar session. And before we proceed with the webinar, I would like to have a quick introduction of you people. If you could just, I could see few names which are actually which I could have, which I've seen in the previous days of the webinar also. If there are other students who have joined in for the first time today, can you just please confirm that are you looking for a PKN, which is the Taxation Pakistan variant webinar, or are you looking for something else? Are you looking for UK, or are you looking for a Pakistan webinar? Because I guess you may actually be here for the UK webinar. Okay. No, this is actually a webinar session for the ACCA Pakistan, for the Taxation Pakistan variant. This is not for the UK variant. And this covers the Pakistani laws and regulations. So in case if you're looking for something for the UK variant, I'm sorry about that. You might actually check the ACCA's website for other resources. Anyways, so up till now, in the past 3 days, we have had various discussions, and our discussions have majorly focused upon sales tax. And today what we are going to do is that we are now going to go to the income tax portion of the webinar uh, of the syllabus. And with respect to the income tax, what I'm actually going to do is that I'm going to go about with the various aspects of the income tax. So if you could just remember, there are actually three aspects of the income tax, and that includes uh, and what does that include? It actually includes this capital gain tax, the individual taxation, and the salary taxation. So this is what the this is all inclusive of. Now, I've shared a handout with you people. The name of this handout is Practice Question Day 4. The handout's name is Practice Question Day 4. You can access this in the webinar window. In this specific handout, the first 3 pages or the 4 pages are actually for the various rules and regulation and the tax rates that are there. So the first 3-4 pages are for the various tax rates. Now, the next is basically you've got two questions. One of them is for the capital gain tax, and another capital gain tax is their Rameez and other. So there are two capital gain tax questions. Then there are two questions pertaining to the individual, which is named Ijaz, and another which is named Ambreen. And then there are two questions for the company, which is one of them is for the Plastic Goods Private Limited, and the other one of them is for the Pakistan Technologies Limited. So these are the two questions that you will have to attempt. Okay, now before we proceed, what I'm actually going to be doing is I'll be attempting this specific question of capital gain tax. The name of the question is Raza. It's one of the ACCA F6 PKN past exam paper. It's one of the recent exam paper. It could either be from this December, it could actually be from December 18, or it could be from June 18. This is what it is. In fact, December 17 or June 18. So this is what it is actually they are taken from. Now let's start discussing about it. Before I move on, I am going to have a quick recall of the capital gain tax and its rules. And uh, as I mentioned to you in my earlier sessions also, that I have covered the capital gain tax in the previous webinar, and you can go through the capital gain tax theoretical aspects from the previous webinar. But for the time being, I'm going to do a quick review of the webinar of the capital gain tax. Now, when we talk about the concept of capital gain tax, so let's actually start discussing that what exactly is this capital gain tax. Let's start discussing about it. The first thing about the capital gain tax that you people need to understand is that the capital gain is basically the gain or loss on disposal of a capital asset. On disposal of a capital asset. So when we talk about the capital gain, so capital gain is the gain or loss on the disposal of a capital asset. That's what the capital gain is. Now, if I move a bit further and if I talk a bit further about it, the first thing is the capital gain is the gain on the disposal of capital asset. So when we actually study the law, the important aspects of the law is to understand the definitions of capital gain tax and the understand the definition of the capital assets and that of disposals. So if I talk about the first thing that you need to understand is basically what exactly is a capital asset. What exactly is a capital asset? We need to talk about it. So if I talk about the capital asset, uh, the capital asset is actually specified as it has got a specific definition which it actually covers up. So various immovable property, and in addition to the immovable property, plus in addition to the immovable property, there are other things that are included in the capital asset, like for example, the securities and the shares and the bonds and the debentures, etc. They are all considered to be the capital asset. Similarly, when we talk about the concept of disposal of a capital asset, so the disposal itself has a very detailed definition. So when I talk about the disposal, so disposal actually means parting basically ownership of asset. Now that could actually be through sale, that could actually be through transfer, that could actually be through a gift, that could actually be through a transmission or by the operation of law, etc., etc. That could be through multiple aspects. So when we talk about the disposal, so the word disposal actually means that when you part your ownership with the asset, that is considered to be disposal. Now let's move forward and let's discuss further. So basically what happens is when we talk about the capital gain, there are basically three types of capital gain that could arise. There are three types of capital gain. Now what are those three types of capital gain? So the capital gain could actually be one which falls under section 37. There could be capital gain which falls under section 37 1A, and there could actually be capital gain which falls under section 37 capital A. Now, what exactly do you mean by all of these capital gains? Section 37, Section 37 1A, Section 37 capital A. So this is generally the capital gain which falls under Section 37 is charged to tax under the normal tax regime. Is charged to tax under the normal tax regime. The Section 37 1A is for the gain on immovable property. Is for the gain on immovable property. And then section 37A is basically the capital gain on sale of securities. It's the capital gain on sale of securities. So when we talk about the capital gains are actually of three types. Either it could be normal tax regime, it could be a gain on immovable property, or could be gain on sale of securities. So when we talk about that, what is considered to be the securities and what is considered to be the normal things. So let's try to understand. Um, these are the various tax rates. This is A and B. I'm not, I have used the past exam papers tax rate. I have not used the latest tax rates. The reason being, when you will be attempting the exam, you will be given a similar type of the tax schedule. So what you need to do is that you need to follow that similar type of tax schedule that you are being given in the examination. So it's actually tax rates for salaried individuals. That's one. And then there is this tax rates for the association of person and non-salaried individuals. That's another thing. It's basically in respect of income from house property, but that's something else. Corporate tax rate alternative. Now it's there. This is what the capital gain on sale of disposal of securities. So basically, this is section 37 capital A. What is it? Is it section 37 capital A? This is actually covered by this. So section 37 capital A. Section 37 capital A is what it covers. Now let's move a bit forward. Also, it says tax rates on capital gain on the disposal of immovable properties. This is section 37 1A. So section 37 1A, whereas it's basically the capital gain on disposal of immovable properties. So these are the basically tax rates, and the normal tax rates are being used for the other one. Anyways, let's talk. So what we are going to do now is we are going to attempt this specific question, which is basically the question named Radha. So I'm going to attempt this specific question, and then we will discuss further. So if I talk about this question Radha, let's just start discussing that what does this question Radha actually is for. The question says, compute the tax payable by Radha for tax year 2018 on taxable income arising from the above transactions. Give brief explanation of your treatment of each item. So what do you need to do? You need to compute the tax payable by Radha for the tax year 2018 on the taxable income arising on the above transaction. And you need to give brief explanation for your treatment of each item. It says the reasons of the items not listed and should be shown separately, so and so, so and so. Now, so what I am going to do is that I'm going to perform the calculations on an Excel sheet, and we will be going through it. So I'm going to name it as Radha. The question is for capital gain tax. Okay, so this is actually a question named Radha. Now, it says Radha is the resident taxpayer and filer in Pakistan. Radha disposed of the following assets during the year ended 30th June 2018. So what has Radha done? He has disposed of the following assets for the year ended 30th June 2018. First of all, it says 20th July 2017. So what has happened? He sold all his household furnishings used for personal use. Sold household furnishings used for personal use in a garage sale. The total sales proceeds on the day amounted to 400,000. Further, it says Raza estimated that the cost of the furnishings totaled rupees 250,000. Now, what we actually need to do is that we need to talk about the accounting treatment for this specific question. Now, so first of all, what happens is, as we did mention, that it's important that the capital gain is the gain on the disposal of capital assets. It's the gain on the disposal of capital assets. So what do we need to do? We need to mention over here in this specific case, and we need to mention that the household furnishing are assets for personal use and do not fall under the definition of capital asset. So the household furnishings are basically assets for personal use and they do not fall under the definition of capital asset. Hence, the gain arising from such disposal will not be treated as capital gain. So this is not going to be considered as a capital gain. Why? Because this is the assets which are being disposed of are actually being used for personal use. So whenever you've got an asset which is being used for personal use, the personal use assets are not considered to be the capital assets. Okay, now what next is there? Let's talk about the second aspect of this specific question. Now, next situation is, it says that on 31st December 17, Radha sold his plot in Naspak Housing Society for 800,000. So what did he do? He sold his plot in the Naspak Housing Society for 800,000. Now what happens is, the resultingly what has happened is, it says the fair market value of the plot was estimated to be rupees 900,000 on the date of sale. Radha had acquired this plot on 1st December 16 for rupees 700,000. Now let's try to understand this thing, that how would we actually go about this. So if we talk about it, so you need to understand one of the concept, which is basically, if the asset is disposed of at less than fair market value, then the disposal proceeds will be deemed to be equal to the fair market value. Hence in this case, the gain on disposal will be 900,000, which is the fair market value, less 700,000, which is the cost, and the gain will be taxed at a rate of you need to understand what is going to be the rate. I'm going to go to page number 2 of this handout. So you will find the rate on the disposal of immovable properties. It says where an immovable property was acquired after 1st July 16 and its holding period is up to 1 year, so then 10%, or if more than 1 year but less than 2 years, 7.5. So what is the relevant rate? It's 7.5% because it's more than 1 year and less than 2 years. So this is actually less than 2 years. Now what next is there? Let's move a bit forward. So this is what it is. Now the third thing that you have is basically on 1st January 2018, I sold 40 acres of farmland for 155,250,000. The incidental cost relating to the sale amounted to 900,000. Rather, I purchased this farmland on 15 January 2016 for 11 million. Expenses of rupees 1.5 million were incurred on 1st July 2017 for improving the drainage of the farmlands, which enhanced its productivity. Now, let's try to understand this. We had purchased this farmland on 15 January 2016. The farmland would also be a separate, because what happens is when you talk about the property is going to be a separate block of income, like because what happens is this is treated as a separate block of income. Separate block of income actually means that it will not be added to your normal income, and instead it would be treated as a separate item. Similarly, the third is basically also a separate block of income, and gain cost of the property will include all the costs that are incidental to acquiring, upgrading, and disposing of the property. So basically what happens is you would say the disposal proceeds. Now what are we going to do? We are going to say net disposal proceeds. So the net disposal proceeds are going to be, we have disposed it off for 15.525 million, and the disposal cost is 0.9 million. 15,525,000 minus 900,000. So when we talk about the net disposal proceeds, it's actually going to be when we talk about the net disposal proceeds, it's going to be 1,462,500. What is it going to be? 1,462,500. That's what the net disposal proceeds are. In addition to the net disposal proceeds, there was this less the cost. So acquisition cost was 11 million, and in addition to the acquisition cost, you'll have the upgradation cost. The upgradation costs are going to be what? Upgradation costs are going to be 1.5 million. Now, resultingly, what is actually going to happen is we're going to say that this is basically going to be um, this 12.5 million. So resultingly, the sum is going to be what? It's going to be 2,125 million, and it is going to be 2.125 million. Now, the tax rate applicable on it is going to be what? So you need to go back to the tax rate schedule again, which is going to be on page number 2 of the handout. So it says if the property was acquired before 1st July 2016, if it was acquired on or after, if it was acquired before 1st July 16. So you just need to know that when was this property acquired. So this specific property was acquired on 15 January 2016. So it was acquired before 1st July 2016. So hence the tax rate which is going to be applicable on it is going to be this 5%, because the holding period is up to 3 years. So the 5% is going to be the tax rate based on the tax that I am using. So the capital gain tax payable is going to be this 106,250. We'll talk about the next aspect of the question. And the next aspect of the question is, it says that 15th March 2018, they sold 5,000 shares in Yogilicious Pakistan Limited, a company quoted. When you have a company quoted on the Pakistan Stock Exchange, that means it's a listed company. And the shares of the listed company are going to be termed as securities. The shares of the listed company are going to be termed as securities. So it says it sold 5,000 shares in Yogalicious Pakistan Limited, a company quoted on the Pakistan Stock Exchange, for rupees 1.8 million. The shares had been purchased by Radha on 1st September 16 on the Lahore Stock Exchange at a cost of rupees 200 per share. So basically what happens is sold 5,000 shares in Yogalicious. The shares had been purchased on 1st September 16. Now what next is there? It says other costs incurred included the following: capital value tax at the time of purchase, brokerage fee at the time of purchase, brokerage fee at the time of sale. So this is all that is mentioned here. First of all, you need to understand that the shares in Yogalicious Pakistan are the shares in Yogalicious Pakistan are classified as securities under section 37 capital A. Their tax treatment will be as a separate block of income subject to prescribed rates. Now what next is there? It's basically now what you need to do is that you need to calculate the gain. How would we go about gain on disposal of shares? So the gain on disposal of shares is going to be established like this. First of all, what is actually going to happen is you would say disposal proceeds. The disposal proceeds are going to be 1.8 million. Then it says the shares had been purchased by Radha on 1st September 16 on Lahore Stock Exchange at a cost of rupees 200 per share. Other costs included the following. The first of all is the capital value tax. It is basically at 0.01%. The next thing is the brokerage fee, and this is actually at zero point 0.3 per share. 0.3 multiplied by 5,000 shares that are being sold. Then fee on disposal is going to be 0.4 into 5,000. So cost of purchase is basically 200 multiplied by 5,000. Then the capital value tax is basically this amount multiplied by 0.01%. So the capital value tax is basically at the time of purchase of 0.01% of the purchase price. So this is how it is actually going to be. Then this is going to be zero point 0.3 into 5,000. 0.3 into 5,000. This is zero point 0.4 into 5,000. So resultingly what happens is, if we sum up all of this, this is how it is going to be. And if we sum this whole, this is what it is going to be. 796,400 is going to be the gain on disposal. 796,400 is going to be the gain on disposal. Now let's move a bit forward and let's try to discuss that. How would we calculate this specific, how would we tax this specific gain on disposal? So when we talk about it, so when we actually talk about it, what is going to be the capital gain on this disposal? So you need to understand. First of all, what is going to happen is the tax rates needs to be checked. The tax rate that needs to be checked is, we're being told that where the security was acquired between 1st June to 1st July 13 to 30th June 16, if you are a filer, if you are a non-filer, where it was acquired on or after 1st July 16. So we just need to see what was the date of purchase of this specific security. So the security was purchased on 1st September 16. 1st September 16. 1st September 16 is this specific section. We would assume that they are actually filer. Would assume that they are filer. A filer is somebody who files the tax return. A filer is somebody who files the tax return. So the applicable rate on assumption of filer is 15%. So this is what is actually going to happen with it. Now lastly, there's this number 5. Lastly, there's this number 5. When we talk about number 5, what is going to happen now? It says on 1st June 2018, they sold 4,000 shares in Bright Light Limited, an unlisted company for 800,000. So Bright Light Limited, an unlisted company for 800,000. Now what next is there? It says Radha acquired these shares as follows. So how were these shares actually acquired? So when we talk about it, these shares were actually acquired like this. First say 15th April 11, 31st, 20th August 13, 18 December 13. It says ignore default surcharge. Now 4,000 shares for rupees 800,000. Now remember, when we talk about the gain or loss on disposal, so before we could talk about the gain or loss on disposal, you can follow two methods. One of them is you can calculate the gain or loss by assuming the cost using the first in first out method, or you can assume the cost using average costing method. The more preferable approach is the average costing approach. The more preferable method is the average costing approach. So the first thing that we need to do is that since Bright Light Limited is not listed, therefore capital gain on its shares will not fall under capital gain from sale of security, and it will be instead it will be taxed under the normal tax regime. Under the normal tax regime, Now, when we talk about that it is going to be taxed under the normal tax regime, so what is going to happen next? Next situation is basically the next thing is you need to calculate the cost of the shares will be established using the weighted average method. So if the cost of the shares will be established using the method, how would it be? Uh, the first one of them was 15th April 11. It was basically 2,000 shares at the rate of, it was 2,000 shares at the rate of 90,000. So basically the number of shares were actually 2,000 and the price for the purchase of the shares was 90,000. Similarly, it was 20th August 2013 and the number of shares were 2,000 and the purchase price was 150,000. Then it says 1 for 4 right issue. So the right issue would be 1,000 and each share would have be at 40. So this is actually going to be this into this. It's going to be 18 December 13. Now, so 15th April 2011, 20th August 2013, 18 December 2013. Now, if this is all going to be, now what is going to happen now? It's going to be like this: 5,000 shares, 280,000. Resultingly, what has happened is 280,000 divided by 5,000. So the average share price is 56. Now, the disposal proceeds are going to be what? We have disposed them off for 800,000. There is no mention of any cost on disposal. The cost of shares disposed. The cost of the shares disposed of is going to be 56 multiplied by 4,000. The cost of the shares disposed of is going to be 56 multiplied by 4,000. Now, if it is going to be like this, so basically the gain on disposal is going to be this one. Now, there is actually a rule which is that if the capital asset is sold after a 1 year holding period, after 1 year holding period, then tax, then gain subject to tax will be 3 upon 4. That is, in this case, what is actually going to happen is 3 upon 4 is what it is going to be, uh, or 75% is what it is. 3 upon 4 is also termed as 75%. So this is actually going to be like this one into this one. This is 432,000. What is 432,000? Okay, so this is how it is. Is everyone okay with this? Any questions, any problems with respect to how we have solved this question? Any issues, any problem? In case if you have any problems, do let me know and I can actually repeat and I can revise. Let me know in case if you have any questions. Okay, that's great. That's great. Yeah, this is basically 75% is what it is, that you have to actually pay tax on the 75% of the gain in case if it's for more than a year. Anyway, so we are done with this specific question. Let's move forward and let's discuss about the next question now. So there is this question called Ramiz. What I'm going to do is that I'm going to give you 5-7 minutes of reading time to actually go through this question, Ramiz. And once you have gone through this question, then we shall actually start discussing about this question. So it's actually Ramiz, which is what it is going to be. So you need to attempt. You've got time till Okay, so let's just start discussing about this question. Um, if I talk about this question, I'm not going to go in a lot of details pertaining to this question. I'm just going to have a quick review of the question. Now let's just start discussing about it. First of all, it says Rami is a filer resident taxpayer. Very important point is he's a filer. Dispose of the following assets during the year ended 30th June 2018. On 1st July, he sold a replica of a rare document of the East India Company for 5,000. The manuscript had been acquired for rupee 100,000 on 25th August 2016 on the understanding that it was an original document. Now let's try to understand that how exactly are we going to talk about it. It's actually a question named Ramesh on the capital gain tax. Now, same question, Ramesh, on capital gain tax. Now, how exactly are we going to discuss this question? The first point is there are several personal assets which fall under the definition of capital asset. There are certain personal assets which fall under the definition of capital asset. Now, what exactly are? Now, so there are several personal assets which fall under the definition of capital asset. Now, so basically what is going to happen is, and in case if there is a loss on disposal of such assets, then the loss cannot be adjusted or carried forward. Such capital assets are listed under section 38 subsection 5. That actually includes the jewelry and the paintings and the rare manuscript, etc., etc. These are the various things. So there's a list of items that cannot actually be recognized as uh, basically the reason behind it is that it says that such items, the loss cannot be recognized or the loss cannot be adjusted and the loss cannot be carried forward on such assets. Now let's move forward. So basically the rare document of the East India Company. So therefore loss on disposal of manuscript of 95,000 will be disallowed. Now what next is there? Let's talk and let's discuss. It says on 5th August 2017, sold 10,000 municipal bonds issued by Lahore Metropolitan Corporation for 22.5 million. The bonds had been acquired on 1st April 17 for 2.25 million. Bank charges relating to this purchase were rupees 25,000. So there were few bonds which were issued by Lahore Metropolitan Corporation. Now, if these bonds are issued by Lahore Metropolitan Corporation, so first of all, you need to understand if these bonds actually fall under the definition of. If these bonds actually fall under the definition of what? Definition of securities. If they fall under the definition of securities, then they would be a separate block of income. If they don't fall under the definition of securities, then that would not be a separate block of income. So let's actually talk about it. So first of all, these municipal bonds will be considered as the securities. The municipal bonds will be considered as security under section 37 capital A. The municipal bonds will be considered as securities under section 37 capital A. The gain on disposal of municipal bond shall be calculated as under. The net disposal or the disposal proceeds. The disposal proceeds is basically 2.5 million, and the cost is going to be first of all the cost of purchase, which is going to be 2.25 million. Then there is going to be the bank charges relating to the purchase. The bank charges relating to the purchase are going to be what? They're going to be 25,000. So resultingly what happens is the gain is going to be what? 22 to 225,000 is going to be the capital gain. We just need to see when was it acquired. The bond had been acquired on 1st April 17 and they're being sold on 5th August 17. So that means within a period of 1 year. So what you would do is that you would say filer and the securities acquired after this. So it's going to be 15% based on the tax rates available. So the applicable tax rate shall be 15%. What else is there? Let's talk about the third aspect of it. It says on 10th August, the company exchange. The exchange is also considered to be disposal. Shares in SPL for 4,000 shares in Interwood. The federal government holds 50% of the shares in SPL and ITPL. Shares in SPL were acquired at a cost of this on this. Face value is this, and the market value at the date of exchange is estimated to have been 90 per share. So the transaction has actually happened on 10th August 2017. Now remember one thing. The important information here is that the federal government holds 50% shares. So remember that there is a definition of a public company. And in case if 50% shareholding is held by parent entity, by a government entity, then it shall be considered as so in case if 50% shareholding is held by a government entity, then it shall be considered as a public company, and hence its shares will be treated as securities falling under 37 capital A. The gain on disposal of such securities shall be as follows. So the gain on disposal of such securities shall be as follows. How much is going to be the gain on disposal of such securities? Let's try to understand. So if we talk about it, what is going to happen is on the date of exchange, because what happens is you'll have to compute the consideration that we have received is what? It's equal to consideration received is 4,000 shares of ITPL, and each share is worth 90. So basically what happens is it's 4,000 multiplied by 90. That's what the consideration that we have received. And the cost of SPL shares were as under: 4,000 shares of ITPL, and then the cost of SPL shares are going to be what? The cost of these SPL shares are going to be 60 per share. So it's actually going to be 5,000 multiplied by 60. So resultingly, it's going to be 5,000 into 60. So hence, the gain on disposal is going to be 60,000. The gain on disposal is going to be 60,000. Now, what next is there? It says the government of Punjab compulsorily acquired Rames's land for its Orange Line train project for 47 million. The land had been acquired by Ramesh on 1st Jan 17 for 45 million and the paid stamp duty of 900,000. The 45 million received from the government of Punjab was used by Ramesh to purchase commercial papers issued by government of Pakistan. No profit accrued on these commercial papers until this. Now what actually happens is um, they have simply complicated the situation, whereas it's just a simple case. They've just tried to complicate the situation by introducing the Orange Line project and by mentioning that they've been compulsorily acquired by the government. So you need to try and understand this thing, that irrespective of whether it was compulsorily acquired or whether it was disposed of by us on a voluntary basis, the end result is it's been disposed of. And since it's a land, so it falls under the immovable property under section 37(1)(a). So what is actually going to happen is, if we talk about it, we are going to say that the disposal of property, the mandatory says the mandatory sale of the property to Punjab government will be considered as disposal, and hence gain on disposal of immovable property is to be recognized. The amount of gain is going to be the consideration, is going to be what? When we talk about the consideration, so we just need to see that how much is the consideration. It's 47 million that we have received. So the consideration received is 47 million. The cost of this property is basically what? The cost of the property is 45 million plus 900,000 the stamp duty. So it's actually going to be purchase price is 45, and then there is something which is actually termed as stamp duty. So that is actually going to be 0.9. Now, so resultingly what happens is, if we talk about it, so 1.1 is going to be the gain on disposal of immovable property. Gain on disposal of immovable property. Now, we need to see when did they acquire the property. So the property was acquired by us on 1st January 17, and it was taken over by the government on 15th March 2018. So we acquired it on what? On 1st of January 2018 17. So we just need to see and check that what is going to be the tax rate applicable on it. So if I talk about it, the tax rate applicable on this specific property is going to be 7.5%. So the tax rate is going to be 7.5%. Number 5, it says 20th March 18, the company sold, Ramesh sold an antique painting. The painting falls under section 38, subsection 5. So this is actually one of those assets. If there is a gain on them, then that gain is taxable. But if there is a loss on them, the loss cannot be adjusted. So we're being told that on 30th April 2018, sold an antique painting which he held for personal use for 1.5. The painting had been inherited on 10th November 2010, on which date its value was 1.1 million. So what happens is, the painting is antique and is classified as capital asset under section 38 subsection 5. It's an antique and is classified as capital asset under section 38 subsection 5. The gain on disposal shall be as follows. It is going to be disposal proceeds, which is going to be 1.5 million, and then there's going to be value at the time of inheritance is going to be 1.1 million. So resultingly, if you see, this is the gain on disposal of this, and proportion to be taxed will be 3 upon 4, which is 0.75. So it's basically 400,000 into 0.75. So amount to be included in taxable income will be this 300,000 pertaining to this specific capital asset that's being disposed of. It's going to be 300,000 pertaining to this specific capital asset that is being disposed of. Okay, let's move a bit forward. And the next thing is, it says on 30th April 18, 2000 shares in Zahur Textile Mills Limited were gifted to his son Imran, who is a citizen of United Kingdom, but has been resident in Pakistan since 20th January 18. Ramiz had acquired these shares at 10 per share. It says at the time of gift to Imran, the market value of Zameen, sorry, it's a gifted 2000 shares in Zahur Textiles to his son Imran, who is a citizen of United Kingdom but has been resident in Pakistan since 20th January 2018. It says Ramiz had acquired these shares at rupees 10 per share on 1st Jan 18. At the time of gift to Imran, the market value of each share in ZMPL was estimated to be 50. There is this additional information which is something which is not going to be considered right now. So, but in overall, the simple thing that is going to happen with respect to this specific transaction is the since his son is resident, therefore gain on disposal, which is through gift, will be taxable. So basically the taxable gain is going to be 50 minus 10 into 2000 is going to be 80,000. So this is what is going to happen. This is what is going to happen. That this is how it is actually going to be. That it says since his son is resident through taxable gain on disposal is going to be this. So I hope that this clarifies. Yes, the gift also means when we say that it's being gifted, the gift is also considered to be a disposal. So the gift is also considered to be a disposal. So we're done with these questions on capital gain tax, and we shall take a break now. And when we come back, so we will be attempting questions on. We shall be attempting the questions on this specific area, which is termed as uh, the income from the individual sections. So you're going to do individual section. That is what we are going to do once we are going to come back. Okay, so let's take a break and then we shall be back again. In case if you have any questions, just to let me know. So up till now we have done questions on this capital gain tax. We are now going to resume again, and when we come back, we shall be attempting the questions on individual. So this is what we shall be doing now. Let's catch you. I'll catch you in this 15 minutes time. Okay, so welcome back. We are now going to start discussing about this. We are now going to move forward, and as I mentioned, that we are now going to be discussing about a few of the aspects of individual taxation, and then we would try and do a question on corporation tax also, in case if the time permits us to go about. So let's actually move a bit forward and let's try to discuss further things. Okay, so the next question that we shall be discussing is this question of December 2017. The question is basically taken from the ACCA's past exam question, and this question is actually on a person named Ijaz. What I'm going to do is I'm going to discuss about uh, that what exactly do mean, what exactly are we required to do in this question. It says that compute Ijaz's taxable income and tax payable for tax year 2017. Give reasons for the treatment of any items excluded from the taxable income or for which no expense or deduction is allowed. So we need to perform the calculations of tax, and we need to actually uh, mention that what items are included and what items are not included. So that is what we have to do and we need to discuss. Now let's move and let's talk about it. First of all, it says Ijaz is a 55-year-old person. Where is this age of 55 going to be used? So when we will be claiming the tax credits, we will be using this age at that point of time. So it says Ijaz, who is aged 55, is employed as salesman by Farva Pharmaceuticals Limited. His earnings and relevant expenditures for the tax year ended 30th June 17 are as follows. So Ijaz, who is aged 55 years, is employed as a salesman by Farva Pharmaceutical Limited. Now what happens is uh, there is going to be various calculations, various things that we need to do. So it's Ijaz, the individual question. So what we'll do is that we'll simultaneously mention the various aspects. So first of all, Ijaz computation of taxable income for tax year ended 30th June 2017. It's 30th June 2017. So it's actually Ijaz computation of taxable income for tax year ended 30th June 2017. Now let's move a bit forward and let's try to discuss a bit. First of all, the first thing that we actually need to mention about is the income from salary. The income from salary. Now, if I talk about this income from salary, the first thing is it says the basic salary is 25,000 a month. So what happens is basic is 25,000 a month. There are actually 12 months that are there. So it's going to be 25 into this. Okay, here we go. So in case if there are any comments, I'll mention the comments here. The basic salary is this. Then it says of a utility allowance of 5% of basic salary. this payment is gratuitous and not covered in his employment agreement. So basically what happens is the utility allowance, this utility allowance is 5% of basic salary. So it's utility allowance at 5%. So if it is going to be at 5%, this is going to be what it is. Multiply by 12, so you'll have the amount. Now what happens is um, the income from salary includes any amount received because any amount received during the course of employment or as a result of employment. This is what we have got. Then it says commission earnings for the year of rupees 375,000. So the commission that you have earned, the entire commission is going to be taxable. Then it says training allowance of 10,000 per month for training newly recruited training salesmen. I'm again going to say that any amount that has been received during the course of employment, that is going to be termed as income from salary. Furthermore, it says in February 17, Ijaz won the Salesman of the Year award. The award consists of a paid 15-day holidays along with tickets and a hotel stay in Bali at a total cost of 450,000. Now, if he is going to Bali, it's actually as a bonus, as an award, as a reward. He's not going to Bali, Indonesia for the purpose of working for the company, but instead he's going there for the purpose of enjoying. So since this is actually a bonus that is being given to him, bonus or the award, so this bonus or award which has been given to him, it will also be included in the taxable income. So it's 450,000. It's once. It's 375,000. Okay, so the bonus and the award is also going to be taxed. And why? Because it is not being given for the purpose of going on work for the company, but instead it's being given in order to actually go for his enjoyment and for his own leisure. So it's going to be a leisure trip. So it's going to be treated as income from salary for the person. Now it says Ijaz is provided with a car by FPPL, which cost company 1.15 million. The running expense of the car incurred during the year and reimbursed fully by FPPL were 230,000. The logbook of the car showed personal use of the car as 20%. So what happens is, the running expenses, of the car, which were of 230,000, what happens is, the proportion for which the car was used, for, so basically what happens is, the expenses relating to business are not taxable, and only expenses and only sorry the payments related to business expenditure are not taxable. Only the personal payments are taxed. Only personal payments are taxed. Now let's move forward. Furthermore, it says that there was actually a car that was given by the company. So so what is actually going to happen with the car is, it's 1.15 million, and 5% of the car is going to be added to the uh, 5% of the car is going to be added to the income from salary. So what happens is, if a conveyance is provided and is partly used for personal and partly for business use, then 5% of the cost of such conveyance will be included in the income from salary. So the conveyance, if it is there, then what happens is 5% of the cost of such conveyance is included in the salary. Now what else is there? Let's talk. The next thing is, we're being told, in addition to the medical allowance at 9% of his basic salary, Ijaz was also reimbursed treatment expenses of 440,000 for indoor treatment at a private hospital in accordance with the terms of his employment. So what happens is, the medical allowance, it's actually at 9%. The medical allowance is at 9%. So how exactly are we going to do it? 9% multiplied by the basic salary. It's going to be the 12 months. Now you need to understand something. Now, if an employee is provided only medical allowance, then such allowance is exempt up to 10% of basic salary. Furthermore, if an employee is allowed reimbursement of medical expenses in accordance with terms of employment, then such reimbursement is exempt, and any other allowances shall become taxable. So this is what you have to consider. What do you need to consider? This is what you need to consider, that In case if any one of the students could assist with this specific error, because okay, okay, that's great. Thank you for your suggestion and help. Thank you. Now, so basically, what happens is, um, this is how it actually goes about. Now, what next, sister? So the next situation is basically, if we talk a bit further, it says Ijaz and FPPL contribute 2,500 per month towards the recognized provident fund. Now, what is this? This contribution to approved pension fund. Contribution to approved pension fund, approved provident fund, to recognize provident fund. Now, what is this contribution to recognize provident fund? Let's try to understand. The contributions by the company into the recognized provident fund are exempt up to 1/10 of the basic salary plus dearness allowance. Now, what is going to happen is, the 1/10 of basic is 300,000 into 10%. So this actually gives you 30,000. So if this actually gives you 30,000, we need to see how much is there. So let's just try to understand. It's 2,500 per month, 2,500 per month for a period of 12 months. So this is entire going to be exempt. So whatever the amount is going to be, it's going to be exempt up to 10% of the basic salary. So resultingly, what happens is the amount to be included in taxable income is going to be zero. Why? Because there is a specific rule relating to it that 1/10 of the basic plus the DA is going to be exempt. In this specific scenario, there is no dearness allowance. Had there be a dearness allowance, then the things would have been like that we would have considered the dearness allowance also. But in this specific case, the dearness allowance is not applicable. Now, what next is there? Let's try to understand. It says FPPL advanced Ijaz a loan of rupee 1 million on 1st January 2016 at a markup of 2% per annum as per the policy of the company. Now let's try to understand. We are talking about a year end of 30th June 2017. The loan amount is 1 million. So basically what happens is, the loan on, the interest on loan advanced at a reduced rate. So what is actually going to happen is the amount of the loan is 1 million, and the percentage which is actually applicable, because what happens is, the government has prescribed a benchmark rate is 10%. In case if any loan is obtained from the employer at a rate lower than 10%, the benchmark rate is 10%. In case if any loan is obtained from the employer at a rate which is lower than 10%, then an interest equal to the difference between 10% and the rate charge is added to the income from salary. So in this specific case, what is going to happen is it was 10% minus 2% multiplied by 6 divided by 12. Now, why is it multiplied by 6 divided by 12? The reason behind that is you have obtained the loan for a period of 6 months. So the interest at the benchmark rate would be charged for a period of 6 months. So this is what is the amount that needs to be included in the income from salary. Now what next is there? Ijaz opted for an employee share scheme under which he was issued 5,000 shares in Marwa Pharmaceuticals Private Limited, an associated company of FPPL, for rupees 400,000 on 1st March 2015. So what happens is Ijaz opted for an employee share scheme under which he was issued 5,000 shares in Marwa Pharmaceuticals Limited, an associated company of FPPL, um, for 400,000. On 1st March, these shares could only be sold on or after 1st April 17. However, Ijaz sold the shares on 1st July 17 for 900,000. The fair market value of the shares on the relevant date was as follows: on 1st March, on 1st April 17, on 30th June 17, and on 1st July 17. Basically, what happens is the employee share scheme. Employee share scheme. Now, what happens with the employee share scheme is um, there are basically two types of the shares that are being awarded to employee. In case if the employees are awarded shares at reduced rate, then an amount shall be added to the income from salary equal to the fair market value equal to the difference between fair market value and equal to the difference between fair market value and so in case if the employees are awarded shares at reduced rate, then the amount shall be added to the income from the salary equal to the difference between fair market value and the cost of purchase. The fair market value shall be the value on which the shares are granted in case of unrestricted stocks, and fair market value of the earlier of date when restriction expires or the date when shares are sold in case of restricted shares. So in case of restricted shares, this is what is actually going to happen, that with respect to the employee share schemes, the things are going to be like this. Uh, Here in this case, it was a restricted shares, and the restriction expired on 1st April 17, so they were for 800,000. And you were being awarded the shares for 400,000. So what is actually going to happen is the capital gain or the amount to be included in salary is going to be equivalent to 800,000 minus 400,000. So the gain, the amount to be included in the income from salary is 400,000. Now what next is there? It also says that on Ijaz sold the shares on 1st July 17 for 900,000. The fair market value of the shares on the relevant date was as follows. Now what happens is you need to understand that this is also a concept which is called the capital gains. Now when you talk about the concept of capital gains, so what actually happens is here the shares were sold on 1st July 17. We are talking about the financial year ending on 30th June 17. So the capital gains, no tax will be, no gain will be shown as the shares are sold in the month of July 2017, which falls in tax year 2018. Now what next, sister? He says Ijaz had to spend 1 week in risky area in connection with a sales campaign for a new product for which he was given a dangerous working condition supplement of 50,000. So basically what happens is the working condition supplement, if they are being given to you, they are also going to be taxed. The working condition supplement, if they are being given to you, they are also going to be taxed. Now let's move a bit forward and discuss about the next aspect. It says other receipts. A labor court awarded Ijaz 900,000 in respect of his unfair dismissal claim against his former employer. When making payment of the awarded amount, his former employer withheld tax of rupees 90,000. Ijaz paid 80,000 to his lawyer through a cross check. And what happens is in connection with the court proceedings, so and so, so and so. Now remember one thing, which I mentioned in the first part also, is that in case if you receive anything from the employer during the course of employment or because of the result of the employment, that is going to be included in the income from salary. And the expenses are not allowed in the income from salary. So we'd say the labor court award of 900,000 time period 1. Um, you would say that the expenses cannot be claimed against income from salary computations. Now what next is there? It says other amounts of tax withheld at source for this, this and this. Now what is going to happen is we'll have the taxable income of Mr. Ijaz. We'll have taxable income of Mr. Ijaz from here. We'd say the taxable income of Mr. Ijaz is going to be 2.675 million. What is it going to be? 2.675 million. Now what would happen is there's going to be a computation of tax liability. So what happens is salaried tax rates are applicable. Now if the salary tax rates are applicable, So we would say that what were the tax rates in this specific handout that I've shared with you. Again, I'm repeating it again. I'm not using the actual rate of tax, but instead I'm using the tax rate that I've shown to you. So 2.675 million. So that means this is what is going to be used. It's 259,500 plus 20%. So tax on 2.5 million, 259,500. Tax on balance at 20%. So it's going to be 20% multiplied by this 2670500 minus 2.5 million. So this is actually what it is going to be. The sum of them is going to be like this, 293,600. Now, if it is going to be 293,600, now what is going to happen? Let's try to understand. So this is 293,600. This is what it is. Now what next? We would say that the taxes already deducted. Now, what are the taxes that have been already deducted? We would say less tax already deducted. Now, when we would talk about the tax already deducted, let's try to understand this. The tax already deducted would actually mean that whatever the tax that has been deducted at upon payment, like for example, there was this 90,000 tax withheld from labor court award, which is basically 90,000. The next thing is deducted by FPPL. Deducted by FPPL is going to be 190,000. Then it's telephone bills is going to be 3,000. And also the tax paid on function in restaurant is going to be this 9,000. The tax that has been deducted, oh sorry, the 8,000 is going to be deducted here. Resultingly, what would happen is you will have the tax which is going to be paid will be this one, 2,600. This is the net tax payable slash refundable. So you will be required to pay a tax of 2,600 to the government. So the tax which is going to be payable to the government is going to be 2,600. I hope that this is clear to everyone. In case if you have got any questions, please do ask. In case if you have any questions, please do ask. I'm going to just zoom out the whole working which I have done so that you people can have a better look at this. So I'm zooming it out. Okay, so we're done with this specific question named Ijaz. Now, what I would want you people to do is to actually go through this specific question, the name of which is Ambreen. And this question is actually based upon an individual who has a business. So let's try to attempt this question, then we shall start discussing together. Let's try to attempt the question. Okay. I hope you would have tried this question. So have you been able to attempt the question? Okay. How did you find this question? Okay. This was from the business. Yes, this was from the business aspect, because as I did mention that I'm going to go through this individual taxation. So one of the questions that I did was basically from this income from salary, and now I've taken this income from business. Now let's actually start discussing about this question. The name of the question is called Umbreen. So it's Umbreen, computation of taxable income for tax year. Computation of taxable income for tax year 2018. So we're talking about Umbreen, which is basically computation of taxable income for tax year 2018. Now what next is there? It says Umbreen runs a beauty parlor in Lahore. She is also a part-time employee at Apwa, giving lectures to its members on body care. The following information relates to Umbreen's income and expenditure. So following income information relates to Umbreen's income and expenditures. Now, let's try to talk about it. What does it say? It says that income is given to you, and in addition to the income, you're also being given the expenditures. Now, there's this net income which is given to you. Now, what do we need to do? There are a few referrals to it which we also go about. So, but the important thing is here we need to calculate the income from business. What do we need to do? We need to calculate income from business of Umbreen majorly. Now, how would we go about it? The net income declared is basically 638,500. We are going to add up few things and we are going to deduct few things. So the net income declared is this. Now let's talk about it. Let's discuss. The first thing that we need to understand is it says sale of products to ordinary individual customers. Tax refund received from income tax department for tax year 2016. So what happens is the tax refund received will be deducted 575,000. The comment section now what is going to happen? It's basically going to be like this. First of all, we're going to say that when we talk about this tax refund received, let's try to understand. You're going to say that the tax refund is not considered as income for as per the tax rules and instead it is shown as reduction of advance tax paid to government. So the tax refund that has been received to you will not be included here. It says additional payment received on delayed tax refund. So the additional payment which has been received will also not be, since the tax refund, the additional payment received. The treatment is going to be like this. It's just that it is also not going to be added to the taxable income. It will be removed. Now this is not taxable as paid by government. Further, it says salary net of tax of 44,500. This. So what happens is the salary income, and since it was 1,005,500, so the income from salary is shown under separate head of income and is not treated as income from salary, as not treated as income from business. Then there are expenditures. It says materials consumed in the beauty parlor. It says material consumed in the beauty parlor. It's about 977,000 the materials consumed in the beauty parlor. So what is going to happen is we have got a reference note available here. It says this amount includes chemical costing 45,000 which expired and had to be destroyed. So this amount include the chemical which was basically expired. So what happens is the chemicals that have expired, what happens is no adjustment is necessary as this is a normal business expense that the materials held are become obsolete and are destroyed during the course of business. During the course of business, these are usually destroyed. Okay, now what next is there? It says rent of beauty parlor premises, number 2. Because the rent was below 1.5 million a year, as individual Ambreen did not deduct any tax from the rental payments. Now what happens is the rentals paid. The rentals paid will be disallowed as an expense. Now you would say why? they'll be disallowed as an expense because if if an entity is required to deduct tax from certain payment, and if it fails to make such deductions, then such expenses shall be disallowed. Then such expenses shall be disallowed. Now what next is there? It says the purchase of equipment of 90,000. So the equipment is a capital expenditure and cannot be allowed as an expense. The equipment purchased of 90,000. So it's actually going to be a capital asset. Capital asset, and depreciation is to be claimed. What next is there? It says wages paid to beauty parlor staff, which is of 1 million. Now what is this note number 3? It says the wages paid to beauty parlor employees are based on number of hours worked. Wages paid, all the wages were paid in cash. All the wages were paid in cash, and the amounts paid per employee range from 15,000 per month to 18,000 per month. Now, what happens is the entire wages which have been paid will be disallowed as an expense. The entire wages which have been paid will be disallowed as an expense. Now, why is it going to happen? Let's try to understand. Let's try to discuss about it. Because what happens is the salary payments that can be made in cash are maximum 15,000 a month. In case if salary in excess of 15,000 a month is paid in cash, then such salary is not allowed as an expense. Then such salary shall not be allowed as an expense. Now what next is there? The next situation is telephone bills including sales tax of 40,000 and income tax of 25,000. So the telephone bill including the sales tax and the income tax. Now try to understand this. When we talk about the telephone bill, whatever the income tax, that will not be allowed as an expense. So what happens is you need to add back the telephone bill income tax. And the telephone bill income tax is going to be, 25,000. So what we would do is that we would say that income tax paid is not claimed as expense. So if you claim income tax, it's not claimed as an expense. Now what next is there? The additional information is available, and it says Ambreen has a speculation business loss brought forward from the tax year 2017 amounting to 190,000. We're going to talk about the speculation a bit later. So I'm just skipping this adjustment for the time being. It says Ambreen's business assets are all classified as equipment and had a total cost of this, against which capital allowances of this had been claimed till 30th June 2017. There was another equipment which was purchased of 90,000. So let's talk about this assets. So what I'm going to do is that I'm going to perform calculations for the depreciation here. The depreciation calculation needs to be performed. So when I talk about the equipment, so I would say first of all, let's talk about the old equipment. The cost of the old equipment was 2860,000. Its accumulated depreciation, which is also termed as the accumulated capital allowance, is 1360,000. And then there is this carrying amount, which is going to be, there's this carrying amount, and this is going to be 1.5 million, or you can call it tax WDV. The depreciation at the rate of, I will just have to see, because as I mentioned that I have shared with you the tax rate. So it says plant and machinery not otherwise specified 15%. So it's going to be this into 0.15. So it's 225,000. So what is going to happen is you will claim depreciation on equipment. Depreciation on old equipment is going to be 225,000. What is it going to be? 225,000. And then we have got a new equipment. What have we got? We have got new equipment. We have got new equipment. And when we talk about the new equipment, we would say that the new equipment, we have a cost of 90,000. There's going to be an initial allowance on this new equipment, and the initial allowance is usually on the eligible assets is 25%. So the initial allowance at 25%. So it's going to be this into 25%. So the WDV is going to be, the WDV is going to be like this. Then you'll have depreciation at 15%. So which is going to be this into 0.15. So resultingly what happens is depreciation and initial allowance on new equipment. So it's actually going to be this much. $32,625. Let's talk a bit further about it. It says that Ambreen obtained a car on a finance lease from a scheduled bank. The total value of the car was this, and its proportionate use has been as follows: 50% for the beauty parlor business and 50% for our employment. No depreciation has been claimed on the car. During the year, Ambreen made payments of 250,000 towards the principal amount and also 70,000 towards finance charges. So basically what happens is the car lease rentals will be allowed at the rate of 50% because 50% is used for the business purposes. So basically this 250,000 is the rental that they paid, plus 70,000 is another thing, multiply by 50%. So 160,000 is what is going to be claimed. Further, it says Ambreen has 2 children and they study at the medical college. So anyways, I mean, So 483.75 is what it is going to be. This is going to be the income from business. Okay, this is going to be income from business. Now you'll be required to pay tax on this. So this is how you will be working, performing the calculations for this. There was one more adjustment that I actually skipped, that was about a speculation business. Speculation business is defined as one of those businesses where you don't take the actual delivery of the goods, but instead you settle on a net basis. So that is considered to be a speculation business. Generally, what happens is when we talk about the speculation business, the loss of the speculation business can only be offset against the profits or the gains of the speculation business, and it cannot be adjusted against the gains or losses of the normal business. So you need to deal with the speculation business separately, then you can actually go about it. So basically you need to deal with the speculation business separately. So anyways, I mean, now we have the taxable income and we'll compute the tax liability and we'll accordingly pay the tax on it. So that marks the conclusion of this specific question also. In fact, one more thing that needs to be added to it is the income from salary also going to be added up. So the income from salary plus the income from business, that's going to be the combined income. So anyways, that marks the conclusion of this specific question, and that also marks the conclusion of today's session. Before we go on concluding the session, I would appreciate if you could actually ask any of the questions that you have with respect to whatever that we have discussed today. And any questions that you may have, just let me know and I'm going to answer. Okay, thank you. Thank you for your feedback. Thank you for your comment. Um, well, for tomorrow, what I actually plan is I plan to go about discussing a few of the aspects that I have not covered in the session up till now. So I shall probably be discussing few things about the withholding tax and few things about how the tax, this litigation and everything takes place, so that we can have a complete coverage of the syllabus. That's what my focus is going to be in tomorrow's session, inshallah. Yeah, thank you very much for your feedback. Thank you, it's highly appreciated. Okay, we shall conclude it here, and inshallah we will meet up tomorrow again at 8 p.m. Pakistan Standard Time. So I look forward to welcoming you all. Thank you very much.